Welcome back to The Explainer. Today, we are taking a pretty wild journey from the heavily guarded, ultra-complex halls of the U.S. Central Bank right down to the sidewalks of our own local communities. We're going to decode the Federal Reserve and uncover exactly how its towering macro-level decisions end up dictating the growth, the hopes, and most importantly, the wallets of our neighborhoods.
Here's our incredibly quick roadmap for today. We'll start by meeting the Fed, looking at its 5 core powers, and cracking open that monetary policy toolkit. Then we'll pivot down to Main Street economics, and wrap up with culture and growth.
All right, let's jump right into Section 1, Meet the Federal Reserve.
So our story actually starts over a century ago. The Fed didn't just pop out of thin air, it was born out of absolute necessity. Back in the early 1900s, a really devastating series of banking panics left the U.S. economy in total chaos. To fix that, President Woodrow Wilson signed the Federal Reserve Act in 1913. The ultimate goal here? To create a permanent, stabilizing force for the entire nation's financial system.
Now, the real genius of the Fed is how it balances power. It relies on a 3-part structure. First, you've got the Board of Governors, which is 7 members up in D.C. representing the national government. Then, you have 12 regional reserve banks that act as the operating arms out in the field. And finally, the FOMC, or Federal Open Market Committee. This is the key monetary policy body with 12 voting members, and it perfectly blends that D.C. oversight with local, regional insight.
Notice the strategic placement of those 12 regional banks. We're talking everywhere from New York, the absolute beating heart of the financial markets, all the way out to San Francisco. This massive footprint is absolutely crucial because it ensures the Fed isn't just trapped in a DC bubble. It stays deeply connected to on-the-ground economic realities from literally every corner of the country.
Moving right along to Section 2, the Fed's 5 core powers.
To serve the public, the Fed wields 5 official powers. First, it conducts monetary policy to steer the economy. Second, it actively promotes overall financial stability so systemic risks don't explode. Third, on a much more micro level, it supervises your local banks to keep your deposits safe. Fourth, it fosters secure payment systems, meaning when you tap your debit card, the money actually transfers. And fifth, it champions consumer protection and community development. It's a massive mandate that touches literally every single dollar you spend.
And that brings us to the famous dual mandate. It's basically a massive high-wire balancing act. On the left side, the Fed is legally required to promote maximum employment. They want to keep everyday people working. But on the right side, they have to ensure stable prices, typically targeting a 2% inflation rate. So they are constantly pulling levers, trying to maximize jobs without letting the cost of your groceries and gas just completely spiral out of control.
Okay, let's get into the mechanics in Section 3, the Monetary Policy Toolkit.
Before we look at their everyday tools, we have to look at the break glass in case of emergency option. The Fed acts as the lender of last resort. Now, while that sounds like super intimidating banking jargon, it simply means they have the emergency authority to lend money directly to banks through what's called the discount window. If the financial system is teetering on the edge of collapse, the Fed steps in as the ultimate safety net.
But for everyday operations, they use a much more standard toolkit. They buy and sell treasuries through open market operations, they adjust the discount rate, and they tweak the interest paid on reserve balances. By pulling these specific levers, the Fed sets the target for the federal funds rate. And here is exactly why this matters to you. That single rate ripples outward, directly dictating whether your next car loan, your credit card rate, or your home mortgage is going to be cheap or incredibly expensive.
Let's clear up a huge misconception real quick. Does the Fed actually print money? No way. They do not have a giant money printer hiding in the basement. The physical dollars in your wallet are actually produced by the U.S. Treasury. The Fed simply distributes that money and retires the old, worn-out notes. So yes, they influence the money supply through policy, but they are not the ones running the printing presses.
Which brings us to a major pivot. Section 4, Main Street economics.
We're going to completely leave the cold, calculating mechanics of D.C. banking behind right now and drop down to the human level. Because economics isn't just for Wall Street experts in fancy suits. It's honestly best understood like 2 friends just chatting on the sidewalk. When we strip away all that fancy jargon, we can finally see how these massive economic forces directly shape the daily, lived realities of regular people.
To really grasp Main Street economics, we rely on this incredible 4 pillars framework. First up is growth, which just means growing smarter about money. Second is local economics, meaning how jobs and prices actually function right in your neighborhood. Third is emotions, because let's be real, financial decisions make regular people feel either incredibly hopeful or absolutely terrified. And finally, ethics, what is actually fair and responsible for our communities. This is exactly how the cold, hard numbers of central banking translate into warm, human realities.
Finally, Section 5, Culture, Community, and Growth.
Here's the absolutely crucial takeaway regarding the partnership between massive institutions and everyday individuals. The central bank, they just set the table. They provide the steady engine of jobs and stable prices. But it's our local culture, how our families stick together, how neighbors actually look out for one another, and how much we value hard work that takes those raw economic conditions and actually turns them into a meaningful life.
Look, when we zoom in on urban environments, we see a really stark contrast. On one side, there are undeniable struggles, violence, school dropouts, and fear. These realities hurt people, and they totally hamstring the local economy. But on the flip side, we see the proven, historical power of cultural growth. When strong families, great teachers, and genuine community pride take root, hopelessness gets completely replaced by hope. Neighborhoods really can turn things around when positive culture becomes the standard.
Building that positive culture doesn't happen by accident. It requires specific, actionable steps. It starts with teaching kids that learning and respect actually matter. It means actively supporting parents so families can stay intact. It involves building deep community pride and doing the right thing, even when it's incredibly tough. And it requires creating genuinely safe places where young people can dream. Because humans are quite literally built for growth when they are given the right tools and real hope. And guys, this isn't just theory, it's happening out there right now. Just look at the initiative over at USA Positive Expectations, where a citizen actually wrote 21 letters directly to the Fed. This is such a brilliant example of everyday people actively advocating for fairness and demanding that kids get a strong start. It forces these massive economic institutions to face the ethical, community-focused realities of their policies. It just goes to show that speaking up actually plants the seeds for real change.
Which brings me to the ultimate question I want to leave you with today. We've just seen the massive power of the Fed's monetary toolkit, and we've talked about the incredible resilience of Main Street's cultural pillars. So how can your strong local values and a stable national economy work perfectly together to create positive expectations for our cities? Take a minute to think about how your own neighborhood intersects with the immense power of the Federal Reserve. Thanks so much for joining me for this explainer, and I'll see you all next time.